So good afternoon and good evening and good morning to some and many and all. We have some interesting things happening in the market, and it kind of spawned the conversation that we've been having in the past about the various markets that we're going to trade and how we're going to do that whole thing. I think today is a good time to talk a little bit about some of the other markets we're going to be looking at, how we're going to judge some of this movement. I feel like I see some interesting things happening in the stock market right now that make me think we need to kind of protect ourselves a little bit. So let's talk about what that is. And go for it. Okay, so tell me if you guys, Zoom is being 200% weird today. It's been giving me problems all day long, so I hope that it will work for us. Is everybody seeing the charts and seeing my screen? Is everything looking okay there? Do you see me? Do you see the charts? Do you see the screen? Everything functioning? Zoom's been a little temperamental. I don't know if it's the 99 zillion users on Zoom or not. Could be. Oh, is that what it is, Lenny? A new version's out today. Something has been, I mean, it's been super temperamental. I was on with one of my programmers on Zoom today, and it was crashing for both of us, and that was kind of the beginning of the end. Everything stopped kind of working at that point. So it must be that update's just working beautifully. So, okay. All right, Sherry, you see everything good? Excellent. Excelente. All right. They just had an update recently. Okay, yes. Hey, Dale, good to see you, my man. Nice to see you. Welcome, welcome. All right. How's things out there? And I don't want to give away your location, but Dale lives in a nice place that most people would like to vacation on as regular of a basis as possible. Although I think the vacationing out there has probably been pretty limited. I know with quarantine, and so many places have required long quarantine periods to come in and so on. So yeah, Dale's out there in Hawaii. So living the good life. If you have to be quarantined, I think Hawaii is a pretty darn good place for it. I wouldn't mind being stuck in a place like that. That'd be all right. Okay, guys. So, right. That's what I've heard. Quarantine to get in there. That is kind of crazy. Okay, guys. So let's talk a little bit about what I'm seeing and why I think we may need to cross market lines a lot, because we have been talking about how. Well, let me just tell you what kind of my brain is right now. Number one, we've been talking about how the strategy that we use for stock and options is the strategy that we use for trading that whole situation, starting with a credit spread, going naked put, and ultimately taking assignment of the stock, turning it into a covered call. I'm pretty sure is the greatest strategy on the planet. Like, I'm just 100% sure of it. That works in a typical normal moving market, right? If we go over here and we look at, this is the S&P here, for the most part, since I was born in 2009 here, it's, the S&P has been going up, right? But we get these kinds of periods here, right? We get these big dips, right? 2007, high at 2007, low 2009, right? Huge dip there. We got some pretty good dips over here, some pretty good dips here. Obviously, our Corona dip. So we get this kind of stuff, right? But that's a pretty minor portion of the overall movement, right? These kinds of noisy periods in here make up a pretty small portion of the overall movement. I would say, if I had to take a wild guess, this is for the most part in a slightly longer term trend been going up probably 75 or 80% of the time, and going down 20, 25, maybe 30% of the time, somewhere in that area there. Hey Raymond, nice to see you. Second way through your or halfway through your second quarantine. I don't know, being locked in my house. My wife was sick, by the way, 2 or 3 days ago. She got sick, and because you can't get a cold anymore these days, she had to go get tested for coronavirus. We had to keep our kids home from school for like 3 days, and it was all terrible. It turned out to be a cold, no corona, anything. It was terrible, and I thought, if things get worse and they cancel school and so on, it's not a good time. But we're doing our best to not spread any disease. But it's hard. I'll tell you, it is hard. Okay, so going back to these charts here, this is what we see happening. This is how the stock market moves in general. And this is why the strategy that I use when I just say, look, for the most part, the market's going to go up. It's going to be going up. It's going up. Let's just trade our strategy. But there are times where we have to start saying, okay, things might be changing. Things might be adjusting. Things might be moving in a slightly different direction. And we need to kind of be ready for that, right? Sometimes it's obvious. Sometimes it's not obvious. Stocks, for this reason, I stay long stocks, right? Stay long, meaning I'm only buying bullish, the stock market. I don't pretty much ever do anything with a put other than, well, everything that we do with puts, but I'm never trying to buy a put on the stock market. I'm never trying to short a stock. I'm pretty much never trading a bearish call spread, because if we just look back and we say, okay, what's the stock market done for the last 10 years? Obviously, we could go into a 10-year bear market, a 5-year bear market, a 2 or 3 year bear market, and then we're not doing so good being bullish there. But even with our strategy, we can still come out pretty good. But when the market does go bearish, there are great times, and this is our nice big intro to trading currencies, right? So when the market goes bearish, this is great currency trading, and likewise high volatility. So when the VIX is up, this is also just really excellent time for currency trading. So a bearish market is great for currency trading, and a high volatility market is good for currency trading. Now, I'm not proposing that the market's going to crash or that this is the end or anything like that, but I feel like we're kind of in a little bit of a crossroads as far as the market goes, and this is where we may need to be kind of looking at a few of the other details. This is the crossing the market lines that I'm talking about, where we're going to start incorporating some other markets, and we'll be talking about this on our Thursday night webinars. We're going to be incorporating some other markets to kind of A, find continual good trading opportunities, and B, have a little bit of a better understanding for where the market might actually be going. Mel, spreads still work though. Yes, spreads always work, right? And if we do end up in some sort of semi-long-term bearish market, then I'll be trading bearish call spreads. We'll do that. We can stay on that side of things, and that's fine. We can do that, no problemo. And or there is a strategy, and we're going to talk about this a little bit more in some coming sessions, but where you own the stock and you buy a put, right? And you can use that put, or you can use those shares of stock to avoid taking a loss on the put, but you can also use the put to offset the loss of the shares of stock. So there's opportunities kind of on both sides to still trade long stocks in a bearish market. So my whole goal is to figure out, and I don't know, I guess I have figured it out, at least in my brain, how to stay bullish in the stock market constantly and always make money. And I think we've got that pretty well done. But we do need to make sure that we're watching all these other markets, right? And we're kind of seeing what's happening. Now, currencies will be a great introduction here, because as I look at this, again, bearish market, currencies move a lot. High volatility market, currencies move a lot. When currencies don't do as much is when we have kind of a steady bullish market. Currencies do okay there, but when we have a real steady bullish market, it's kind of a slower, steadier move on the currencies, right? There's still plenty of great trading opportunities, and we can just kind of go with the long-term trend. But when we have, when there is distress in the market, that's when we want to be in the currency side of things. And what got me thinking about that is I've been kind of sending out some videos and sending out some updates. Are you guys getting my video updates on you know, kind of my weekly? Here's a little outlook for the week on the market. You guys seen those? Make sure you subscribe to the YouTube channel. They're all up there. But one thing that I was looking at that kind of got me thinking was this, right? This is a long-term chart here on SPY. So long-term chart, and we're looking at this and we're saying, okay, this is SPY, and we've seen this kind of movement happening here, where it's, you know, it's kind of running up and it's hitting these areas, and here, you know, we've had a kind of a failed attempt, and it's trying to come off that again. You know, I mean, potentially we could see something like that happen. I don't know that that's what we're going to see, but I'd be looking for, you know, some round numbers, 300s, for example, right? So we're hitting the top of this really, really big long-term broadening pattern. And this is usually where the market kind of turns down a little bit. Now, last time this kind of thing happened, here's SPY, here's taking us all the way back, you know, low of 2009, you know, big crash 2009 there. If we go back and we look at this, this is one thing that I was watching as things kind of were cruising along. I was looking a little bit more along those lines right there. But we had a big broadening pattern that lasted like 8 or 9 years, right? Or even a little bit more. And that was this guy. That was watching those lows of 2009 all the way up to here. And we had a broadening pattern. Now, it was a little more subtle than the one that we have right now. You can see it's just, you know, slowly getting a little bit wider and bigger as we go, but still a broadening pattern. And what we had at the top of that broadening pattern was, you know, coronavirus sell-off, right? We had this big sell-off at the top of that pattern. And you know, that's not nothing, right? That's a good signal to say we need to start watching and we need to start being a little bit vigilant. So when we go back to this kind of pattern here, where, you know, this one goes back a lot less, right? But I mean, it still kind of goes, you know, it's been inside of that kind of area since essentially 2015. Now this one's a little steeper, and that's a little, you know, a little more new, and that's kind of taken us back to 2017. But we look at this and we say, okay, that's something that tells us that, you know, A, we have top of this pattern. B, we have the VIX that is coming back down to the lowest level that it's been at since you know, the whole pandemic situation began. So I'm looking at this and I'm saying the market's starting to look a little less exciting on the bullish side to me right now. We're at pretty record levels on S&P. We're at pretty low levels on the VIX. This is kind of a time where I feel like it wouldn't be a terrible opportunity to buy shares of a VIX ETF, right? And just kind of hold on to it. I mean, we're at some pretty low levels. This is starting to look like, you know, a VIX chart that might that might be running up a little bit. And we've got an S&P that looks like it might be running down a little bit. Now, whether that happens or not is the big question mark. But if that does begin to happen, then we need to have something good in our arsenal. It's challenging to make a lot of money in a high volatility market trading stocks. It's tough. All you can really do is hope you're getting a good entry near the lows and go for it, right? Because we really, when it comes down to it, to be safe and smart and keep in the long-term direction, we really need to stay bullish in the stock market for the most part. There are plenty of bearish strategies. I just don't like any of them. And I think that most of them are pretty high risk. So when we look at something like this, you know, the pieces start to kind of come together just a little bit. Lenny, what's the difference between VIX and VXX? So the VIX is the actual volatility index. VXX, UVXY, VIXY, all of these are VIX ETFs. So in the VIX itself, you have to trade futures contracts. In the VIXY or the VXX, that's an ETF, and you can either buy shares of it or trade options on it. And you can trade options on the VIX itself. It's just a little less it's just a little bit less of a pleasant experience. So so we use things like VIXY, UVXY, VXX, and some of these others. And those are just, some of those are inverse ETFs, meaning if the VIX goes up, those will go down. And some of those are just normal ETFs that, you know, that are positively correlated with the VIX. So if the VIX goes up, those go up. So like VIXY is one that I use, for example, a lot. And this one is positive with the VIX itself. So this is just an ETF that follows the VIX futures. So if this goes, you know, if the VIX goes up, this will go up as well. Does that answer your question? Does that sound good? So one thing that I'm kind of looking at here is, as we kind of segue into the currency side of things, this is a chart of the US dollar. This is the dollar index. And what button am I looking for here? This is a dollar index. And the dollar index is a chart that will show us the strength of the dollar against all the other major currencies, like the Australian dollar, New Zealand, and yen, and Canadian, and Swiss franc, and euro pound, those kinds of things. So what this is telling us is typically when the stock market does well, the US dollar does poorly. And when the stock market does poorly, the US dollar does well. So when we have high volatility, so the VIX is up, stock market's down, the US dollar is typically up, and vice versa. So, so right now we have this dollar index chart that is low, but seems to be holding, right? And this is where I'm starting to get a little bit curious about what kind of movement we have potentially coming up here. Dollar index is low, but it's not really getting lower, right? We have this little dip right here. That's just a nice little reversal pattern, meaning, you know, we make a new low and then close at the high. And same thing, these are train tracks right there, right? We make a low, and then the next candle is actually a bullish engulfing candle, meaning it's a bullish candle that's a little bit bigger than that previous bearish candle. So, you know, little signals saying this might be able to hold. This might be able to stay at or above these lows for now, which is strange because the stock market kind of had this real euphoric kind of moment. Everything's good. We got a vaccine, yada, yada. And then it's getting back to, okay, Europe's starting to close down. We're starting to get kind of those types of things happening. And we're seeing the stock market start to sell off. And we're starting to see the dollar index holding. And we're seeing the VIX, you know, at lowest levels we've seen in months. And so we're kind of getting back to this area where we're saying, okay, let's see what other options we have to kind of take advantage of potentially a high volatility market. Now, volatility, we talked about implied volatility in options last week. Implied volatility is very different than the VIX, right? Implied volatility is our best friend for option trading. Volatility, like VIX volatility, is our worst enemy for option trading. So if the VIX is up, option trading is tough. Trading, as you were asking, Mel, trading spreads is tough because a credit spread, we already rely on two positions, so we're looking at two individual option spreads put together. When we have the VIX up, that combined spread gets massive, right? Instead of maybe a bid and ask of 20 and 30 cents, we might see a bid and ask of 5 cents and $1.50. Right? And so it gets real big and ugly as volatility goes up. But currencies, on the other hand, currencies do pretty well. Currency spreads stay very, very low, and they thrive heavily in high volatility markets. So let's talk about a couple of the basics. Some of you have never ventured into the currency market. Some of you are experienced currency traders. So for the experienced currency traders, bear with me. There will be some stuff here that you can still pick up. But for the brand new currency trader, we have we have a lot of basic things we want to look at. So if you can understand options, you can certainly understand currencies. Options are at least 10 times more complicated than currency trading itself, right? So with currency trading, it's very straightforward, right? But let's talk about a couple of the basics that we need to keep in mind first. Number one, in currency trading, this is a little bit of a generalization, but it's kind of not at the same time. We have equal bullish to bearish markets, right? So in currency trading, I personally think that we have about twice as many trading opportunities because we have a pretty equal direction. I don't like, as I've said 1,000 times, I don't like to be bearish stocks. I don't like to be bearish the stock market. On the other hand, currencies are very different because they will go up as much as they will go down for the most part. We do get some long-term trends, but for the most part, currencies go up as much as they go down. So we end up with about twice as many trading opportunities. We have way more bearish markets in currencies than we do in the stock market. The stock market tends to be very bullish. We have, pretty equal to bullish to bearish markets. Number two, with currency trading, there is literally only one. I'm going to say it's kind of a very simple strategy. In that there's a lot of approaches to trading, a lot of reasons why you take entries. But when we're just talking strategies and options, we have, I don't even know how many strategies we have in options, but we have a lot, right? Iron condors and credit spreads and calendar spreads and all these different kinds of things, right? We just have a ton of those strategies. In currency trading, all you can do is be bullish or bearish. That's it. You can be you can bet that the chart's going to go higher, or you can bet that the chart's going to go lower. That's it. You can't, and there might some might say that there's a drawback to that. If you're a huge iron condor trader and you love iron condors, then you're saying, well, I'm missing out on the opportunity to trade a sideways market. Yeah, but that's probably about it. But it's a very simple strategy. All we can do is be bullish or bearish. That's it. Number three, so it's very less complicated, very simple. Number three, we don't have expiration slash time decay, right? So everyone's good on the option side of things, right? Every option has to expire. To every option, there's a season or something. Is that a song? I don't know if that's a song. But we don't have expirations. We don't have time decay. We don't have any of that stuff. We do have some carrying costs when we're holding a currency position long term. We have some carrying costs of interest that we're either paid or we pay daily, but it's pennies, right? So it's typically pennies of the interest that we pay or earn. So there's a couple other details there. And all we're doing here is we're betting on exchange rate differences. Now, the more, so this is where technical analysis versus the rest comes into play, right? Fundamental analysis, all these other kinds of things. So when these things happen right here, technical analysis is only, hey, Kevin, good to see you. I will make it a song. Technical analysis is where we're just saying trends, channels, support, resistance, chart patterns, right? Technical analysis is what we can see on the charts. So technical analysis tends to work better in high volume situations. If you have a technical pattern on a penny stock, it matters about 0%, right? Because penny stocks are very low volume, and one huge buyer or one huge seller is going to move the whole chart. And it doesn't matter what patterns you have in there. It doesn't matter what support or resistance levels you have in there. It doesn't matter any of that stuff. It's just going to matter, hey, here's a big flow, market moves, that's it. But the larger the volume is, the volume profile is a huge deal, right? And the larger the volume is for an individual stock or any kind of market that we're looking at, the more it will react to technical levels, such as a trend, right? A trend is more likely to continue up or more likely to continue down if there's large amounts of steady volume. Support and resistance levels are more likely to break out and continue or cause rejection and give us reversals if there's lots of volume. So, a stock like Apple is going to behave much more technical and much more technically than, say, a stock like maybe Ford or something, right? That is, has far less volume and far less market cap and so on. So there's that side of things. Now, currencies are the most heavily traded things out there, right? Because currencies are traded every second of every day, 24 hours a day. Currencies are being traded, and they're usually being traded between large banks and institutions and corporations and so on. So there's an incredible amount of volume. Trillions of dollars are exchanged every day, which affects the exchange rate of a currency. And so because of that heavy amount of volume, currencies will be very technical. So we can depend a lot more on what we see on the chart versus little surprise weird things that happen, right? For example, if a huge buyer comes into Apple and picks up, 1 million shares of Apple, it'll move a little bit, right? It'll probably cause a little bit of movement. Someone buys 1 million shares right off the bat. That's going to be a lot of money. So it'll move a little bit, but not much, because Apple has, tens of millions of shares traded every single day, right? Same thing with currencies, right? If currencies are so heavy on the volume side of things, they'll stay much more stable in the long run than than like a lower volume stock. And so, some little news announcement or some big buyer or whatever is not going to move a currency or change its course. In fact, because a currency is representing what's happening in a country, it has to be very steady and stay the course in a major way. And so that kind of stability gives us a lot to work with. So does anybody have any questions so far? It's a lot of talking, this is a lot of kind of going, but is that making sense? You guys feeling okay about that? How's that seeming? How's Dale? Okay, good. Anyone else? Excellent, excellent, excellent. Okay, good. So these are the kinds of things we're going to talk about. Let's see. There was one more thing I want to say about currencies. I think that's probably that's okay. So let's talk about what currency trading is then here. So these four things are pretty, this makes currency trading pretty excellent. So some of you are saying, okay, I've never traded currencies. I don't know what this is. I don't know what to do. Again, if you can trade options, you literally can relax part of your brain and trade currencies, because again, there are far less strategies and approaches to currency trading than there are to option trading. So that's good. So when we look over here, just to give you an idea of what a chart means, right? Let's look at a currency pair. Remember, you can't, the dollar index essentially tries to say, here's what the dollar is worth, and we're averaging it out among the major currencies of the world. And we're saying, here's is it stronger or weaker than the euro and the pound and New Zealand dollar and yen and so on. But it's kind of hard, to just trade a currency on its own, right? We wouldn't say, we can trade Canadian dollar futures, or you can trade, Japanese yen futures, but that's still based on how much is it worth in dollars, right? How much is a contract worth? How much is one Japanese yen contract worth in US dollars? More or less, and that's what we're trading. But when we're trading the actual currency market itself, we have to compare something to something else. So here's an example of, let's just say, the US dollar versus the Japanese yen, right? This is US dollar versus Japanese yen. Raymond, do you need a separate account, fiat versus crypto, separate broker? Yes, for typical currency trading, some stock and options brokers offer this, and some do not. I actually talked to Tastyworks and said, why don't you guys offer currency trading? And they said, we're working on it. So as they say about everything, they're trying to add every kind of feature imaginable. And so they'll have this on their platform sooner than later. But for now, there's large US-based currency brokers that you use for this, and you fund it with just a normal account or normal money and so on. So here is the US dollar versus the Japanese yen. Now, we're trading the exchange rate here, right? If this chart goes up, it's all about the order that a currency pair is in. And this is going to be a little bit crazy, but bear with me for a moment. USD, JPY, right? So if we space that out a little bit, the USD is first and the JPY is second. Now, this is just a random example. There are plenty of examples where the USD is second and something else is first, but this just happens to be the one we're looking at. So what this means, whenever we're looking at an exchange rate, you see this number right here, 105.09, right? 105.09. So what does 105.09 mean? That means that it's going to take 105 Japanese yen to buy $1, right? Everybody with me on that? Does that make sense? So this number that we see on currencies is always telling us how much it cost to buy the first currency with the second currency. Now, to kind of put a little more logic in this, if you look at this and you say, okay, I'm looking at the US dollar versus the Japanese yen. If this chart goes up, what does that mean, right? This 105.09 might go up to 108 or 109. So what does that mean? Can anyone kind of work out the logic there? If that chart goes up from 105 to 109, what can we deduce from that? Watson? Anybody? If that chart goes from 105 to 109, what does that mean? Obviously it means the chart's going up, but what does that mean for these two currencies? Yes, yep, exactly. Dollar is stronger. Now, how do we know the dollar is stronger? Because it's now, right now it costs us, if you own yen, yep, exactly, Dom, exactly. So if you own yen, right now you're paying 105 yen and change, 105 yen to buy $1 US. But if that chart goes up, now you have to pay 109 yen or 110 yen to buy $1 US. So the yen is getting weaker, or the dollar's getting stronger, however you want to look at it, but it's costing you more yen to buy the same thing, right? It's like gas being $1 a gallon or being $1.50 a gallon. You're still only getting 1 gallon of gas, but in one case it's costing you less, the other case it's costing you more. Currencies are the same things. We just have to kind of put our mind into a currency buying another currency. And likewise, if this goes down from 105 to say 100, then at that point we're looking at it costing less yen to buy US dollars. So if it only costs us 100 yen to buy the US dollar, then the yen is stronger or the dollar is weaker or both. And there we go. So does that make sense to everybody? You guys all with me on that? That's just kind of it's an important factor, but it's just kind of to give you a little bit of context of what these charts all mean. Good. Okay, so everyone's good on that. Okay, excellent. So now what we do as traders is we have, in currencies, they call it a lot, right? One lot is equivalent to a contract in option trading, right? That's just how it's a lot, it's a contract, whatever. That's our increment of what we are trading here. Lori, is the 105 a yen amount? Yes. Yep. So this number over here is always going to represent the second currency pair. How much it costs the second currency to buy the first currency. So in this case, 105 means 105 yen to buy $1 US. And on the flip side, we can look at something where the dollar is in second position. So here we have the New Zealand dollar versus the US dollar, and the dollar is in second position. And now we have this 0.68378 number, right? But if you get rid of those last numbers, in currency trading, you break down a dollar into a really small amount, right? Like hundredths of a penny. So if we look at this right here, this is telling us that it costs 68 US cents, 68 cents to buy 1 New Zealand dollar. So for 68 cents, you can buy a New Zealand dollar. So therefore, in this case, the dollar is quite a bit stronger than the New Zealand dollar, the US dollar is, because it's, we're paying, it's about, New Zealand dollar is only about 2/3 of the value of the US dollar. Okay. Yep, perfect. Yeah, and you have that as well, right? And that's, over here you can see JPY, Japanese yen. So that's Japanese yen. It's a nice little feature TradingView throws in there, just kind of keep everything straight. But this is where currency trading is so simple, right? We have a lot or a contract. You buy 1, you buy 5, you buy 10, you buy 50. You can buy portions of a lot or a contract. And that's one of the differences. There's a little bit more flexibility on the currency side of things. In option trading, you just buy a contract. That's it. You know, and there are some exchanges where you can buy like a mini contract or a micro contract or whatever. In currency trading, you can really break it up into units, right? Really small units. But again, it is just representing how much money we stand to make, how much money we stand to risk, and how much money it's going to cost to keep it open. Just like just like an option contract. An option contract, if you buy a call or buy a put or whatever, you know, it might cost you $100 or $200 or $500 or whatever. Currency contracts are a little more fixed price. They're not exactly fixed price, but there are slightly more expensive currency contracts and slightly cheaper currency contracts. But again, we don't have expirations. Expiration dates and strike prices affect the price of an option. Currencies don't have any of that. It's just a contract, and it costs whatever however your account is set up to manage the leverage. So you're always just going to pay pretty much the same price, because we're not saying, well, I'm buying a currency contract that expires in a year. They don't ever expire, ever. You can hold on to a currency trade for 10 years. So there's that. But the easy part is we're only going to be bullish or bearish. And this is called being long or short the contract, right? We're either going to tell the broker at entry, we're betting that this contract, essentially the chart that we're looking at is going to go up, or we're betting that the chart that we look at is going to go down. That's it. That's all. Now, it's not uncommon to get into a bearish trade and have this thing go up and then go down, right? Or vice versa. So we have a lot of flexibility of staying in these trades, getting big runs, big moves. When a currency starts to take off and move, it really moves crazy, crazy. And so we can get some really big trades and some really big runs on these, but that's it. So when you look at a chart, and the analysis is a whole other story, and we'll talk about that on coming webinars, but when you look at a chart like this and you say, okay, here is the US dollar versus the Japanese yen. I think the dollar is going to strengthen. I think the Japanese yen is going to weaken. So therefore the chart should go up. So I'm going to open my trading account and say, give me one contract and I'm going to buy to open. That means I'm long, and if the chart goes higher, I make money. Or I sell to open, and if the chart goes down, I make money. That's it. That is currency trading in a nutshell. It's actually very, very simple. There is a lot to the analysis, right? There's a lot to how we approach currency trading. Some of the most interesting stuff, and we'll talk about this in future webinars. I could go on obviously for 10 hours. I've been currency trading for 20 years, and there's a lot to talk about, but there are certain currency pairs that certain currency pairs that react very heavily to certain things, right? When certain things happen in the stock market, we can get very big movements on Australian dollar, New Zealand dollar, Japanese yen, US dollar. The Swiss franc is something that's very heavily, very closely tied to the VIX, to volatility. And so when we start to kind of piece together this big picture, we can see that, you know, for example, if we see the S&P at the top of this major channel, and we see that the VIX is sitting on major support like we just looked at, then we might be looking at some of these Australian and New Zealand pairs that typically do less good in a bearish stock market, right? If the stock market is bearish or going into correction or getting into the high volatility area, then the Australian dollar and the New Zealand dollar tend to do poorly. They perform poorly and they weaken. And so then we start looking at Australian pairs and New Zealand currency pairs, and we start saying, do these have any signals on here that we should believe, or that we believe to be bearish? And so we'll talk all about the analysis and how we are going to analyze a currency chart, which is a huge deal. It's not super complicated, but there are a lot of steps to it. And I'm going to share with you guys my little strategy that I've formulated over the last couple of decades for reading currency charts and for getting an idea on what the stock market might do and how the stock market can help confirm movements on in currencies, right? And how we kind of trade these back and forth. like I said, when volatility goes up, currencies are the best to trade. Stock and options, not so good. So we have a great way to kind of approach the market from both angles. In my trade group, that's what we do, right? When things are steady and calm, maybe we'll trade a little bit more stock and options. When things get a little scary and a little sketchy, we're certainly going to trade a lot more on the currency side of things because we're going to get a lot of movement out of that. So we have a, kind of a multi-angle approach to take there. And that's what I want to talk to you guys about. But we've been going for almost an hour now, and I don't want to go for another hour, even though I can very easily do so. I will leave it at that. Do you guys feel like you have a slight understanding to the currency side of things? Maybe the importance of trading currencies, the importance of understanding currencies, the basics of currencies. How do you guys feel about that whole situation? Lenny, good, Lee, excellent. Dale, it's a great market to be in. It's a really good market to be in. Yep, Mel, you should be good there. Good, Raymond, okay, excellent. All right, and we have a lot to talk about on the currency side of things. It's going to be really good. I'm excited about next week's webinar because I really want to dive in on this. But Lenny, going back to your question there, you're saying how much is a lot? It will depend. And you can see this every broker. So because currency trading is such a big, massive market, brokers offer a lot of leverage, right? They'll offer a lot of leverage, meaning that you put up a little bit of money, they'll put up a lot of money to get you in. It doesn't cost any extra. It's just how currency accounts are set up. They're set up with a lot of leverage. So to kind of give you a little bit of an idea on that, it goes a little bit like this. James, or Jim, sorry, there we go. Currency trading is highly dependent on charting. It is very dependent on charting, which Jim, we are going to help that be a lot less complicated for you. We're going to help that be a whole lot less complicated. So, okay, Lenny, let me go to your question here. So just to kind of give you an idea on how currency trading is done here, this is just a practice account here for the broker side of things. But if I want to trade, this will tell me everything, right? If I'm looking at the US dollar versus the Japanese yen, 1,000 units is considered a micro lot, right? And that's going to tell you down here, that's going to say the trade value of this is about $1,000, and that's about, 1,000 units is kind of representing $1,000. And you're going to make about 10 cents a pip. Now, this one is, like I said, about the smallest trade size you can go with most brokers. So the trade value is $1,000. This isn't telling us what exactly that's going to cost you because it'll be different with every broker. But a contract of this size is going to cost you around $50. Around $50. We go a little bit larger, 10,000. That's now $1 a pip. That's a $10,000 contract. That's now going to cost you about $500, right? That's going to tie up about $500 to keep that one open. So, so your currency trading account will tell you how much it's going to cost you, how much money it will tie up to hold that position open. So yeah. So we'll go over all that, and we'll cover those details certainly on our next detail. But currency contracts are, for the most part, a bit cheaper than a typical futures contract. Raymond, is there a pair screener? Yes, there sure is. Yep, TradingView has one, right? Under Stock Screener here, you can screen for current cryptocurrencies, foreign currencies. Forex is what they call it. That means foreign currencies, foreign exchange. So yeah, you can scan for that. But one of the other things that's good about the currency market is there really is only about 20 currency pairs that you would really ever trade. So you kind of don't really need to use a screener. In stock screening, we have thousands and thousands and thousands of stocks. So we have to use a stock screener. But in currencies, there's really only 20 or 25 that we're ever going to trade. So we can kind of just keep an eye on those very easily. Janae, when you say yen pair, is the yen always the first number, or could it be either first or second? Janae, with most, there are some yen futures contracts where the yen can be in first or second position. For the most part, in the typical currency market, yen's always going to be in second position. So we have Aussie yen, we have New Zealand yen, So these are all kind of in these different areas. We have, you know, CAD, yen. So yen's pretty much always in second position. Okay, so we're going to talk about, and Jim, just to go back to your question and comment there, we're going to talk a lot about charting and how we're going to understand these charts and what kind of things we need to be looking for. It sounds like it's going to be complicated. I promise it's a lot less complicated than you think. So make sure you guys are here next week. We're going to talk about some really good stuff as far as charting the currency pairs goes. So it should be really good. Okay, that's kind of where we are. Lee, honestly, I should probably know this. I don't know why they pick the direct or the order that a currency pair is in, whether the yen's first or second. I don't know. Oh, you're right, Sharon. Is next week really Thanksgiving here? Wow, what is it? Darn. No, next week is not Thanksgiving. The week after is Thanksgiving, right? The week after? Thanksgiving's in 2 weeks. Someone help me out with that? I think Thanksgiving's in 2 weeks, so we'll be meeting next week. Okay, yep, so we'll be meeting next week. We'll talk about the charting. It'll be good stuff. I'm looking forward to it. Okay, guys, that's it for me. I'll leave it at that. Does that help everyone? Do you have any final questions that we can answer before we wrap it up? Does that all sound good, seem good, feel good? Everyone okay with that? If so, we will leave it at that, and I will wish you guys a very lovely, wonderful evening, and we'll kind of take it from there. But we have a lot of things to cover, and I'm really looking forward to it. Raymond, nice to have options to options. Yes, we have lots of options to options. We sure do. We surely do. So it'll be really, really good. All right, thanks everyone. Have a wonderful rest of your evening. We'll see you all very soon. Yeah, a little FX talk, always good, Amy. Yep, take care, guys. Nice to see you all. See you, everyone. Have a good evening.